Good morning, everyone. We will get started in just a few minutes. We'll wait for a few people to log on, and we're going to get ready to have some tax fun. So just stay tuned. Good morning, everyone. This is Marianela Collado, or as most of you know me, Nella, and I'm here with Yesenia Ramirez. Good morning, everyone. We're excited to walk you through the magic of year-end tax planning, and hopefully we can keep you all awake for the next hour. So before we get started, just a few housekeeping. If we can have you all make sure you mute yourselves, and then the line should already be muted, but just to be safe, just go ahead and place yourself on mute. And you will also see on the webinar login that there is a section to ask questions. We will try to answer all the questions in real time as we're talking about the subject, so feel free to ask any questions you'd like. We're also going to leave 10 minutes at the end of our presentation and answer any questions if you have some after we get through the entire presentation. Perfect. And also, before we get started, we will just make sure that you're all aware that we're going to be talking about some general tax strategies. Everything that we talked about may or may not necessarily be a good strategy for you. So with everything, we do ask that you speak with your tax advisor or your CPA, or give us a call. We'd be happy to talk about your specific situation and see where some of these things may be a good fit or not, and why, but just walk you through that. So just like when you see a doctor, don't run off trying to get, prescription medication without making sure that it's the right one for you. So be sure to give us a call or speak with your CPA if there's anything that piques your interest. So just a little bit of background. So I am the CEO and Senior Financial Advisor here at Tobias, and I have the pleasure of working with Yesenia, who has truly embraced tax planning. Exactly. Well, tax planning is one of the favorite things that we do here. I've been on with Tobias for almost 3 years now, so jumping into our third tax planning season. So I'm very excited to
to not only work with our clients and the strategies for them, but also share with you what some of those strategies are.
And I think the magic, and Yesenia, is kind of embracing why tax planning is so important is because we're able to really look at all of our clients' goals and then see what those goals are and then find tax efficient angles and opportunities to achieve those things, and also have sort of gravy on top, which is the tax savings associated with how we actually logistically achieve some of those goals.
Absolutely. And one of my favorite things is that we actually see the benefit of tax planning real time. It's, we always talk about delayed gratification, and of course with retirement planning, there has to be some delayed gratification, but we need to reward ourselves too now and today. So I really do love that tax planning gives us that opportunity to change the needle and see some of those tax savings today.
Excellent. So let's talk about, what is year-end tax planning, Yesenia? What is it that we're looking at? What is it that we're trying to do? Maybe talk a little bit about what it is.
Absolutely. So the main goal with year-end tax planning is really to reduce your overall tax bill, not just this year, but looking at a few years ahead, seeing what can we do to really change the needle, and also make sure it's aligned with those investment goals, because we know tax planning is just not, we can't look at it in a silo. It has to be in conjunction with your investment goals. So we really have to see what opportunities we have available to reduce that tax bill, either by reducing your income or really accelerating deductions in certain years. So it's really playing that tax game to lower it over several years.
Exactly. And also taking into account the fact that things may not remain status quo next year, the following year. So the fact that you're going to have years that may look substantially different, that's where really you present opportunities to change things, because you know that 2 years from now something will happen. What are things that we could be doing today to prepare for that? But really, why is this so complicated? Why can't we just all just kind of, sit in our own computers and figure out our own tax planning? What makes it so complicated?
Well, one of the things is that the IRS code is quite lengthy. That's one. But really, it's the fact that these things keep changing, either the tax brackets, how much you're allowed to deduct, what kind of income gets taxed at what rate. So there's just so many moving parts to it. And again, not everything applies to everyone in any one given year. Maybe we can have deductions allowed in 1 year, and then the next year all of a sudden they're not allowed, which we saw happen with the overhaul of the tax laws. Deductions were changed. So because it's constantly evolving, we always have to make sure we're checking the pulse to see, can we keep doing these same strategies, or do we need to adjust? So that makes it very difficult. We can't just do the same thing year after year.
And I think what's surprising too is, you have so many different rates. Some people, don't even realize that there's actually a 0% capital gains rate. Yeah, that's not a typo. That is actually a tax bracket for capital gains and qualified dividends. So really the name of the game is, when do you take advantage of these things, and what are things that we're looking for to make sure that we're maximizing opportunity within the tax code that we are living in? So to talk a little bit about pretty much the overall goals with tax planning is figuring out the ideal timing. Unlike markets, right? We don't know what they're going to do today, tomorrow. No one has a crystal ball. Tax planning, and maybe that's why I love tax planning so much, is that you can get, pretty down to the T in figuring out sort of what year it makes sense to do certain things by running projections. So figuring out the ideal timing to recognize income to the extent that it's in your control, or maybe trigger capital gains, or delay the recognition of a sale of a certain asset, or the recognition of certain income or bonuses. Clients will come to us and say, hey, I have the option of choosing to start this income stream today, or I can delay it for next year, 2 years down the line. What should I do? And this is where we get excited, because now there are certain things in our control that we can almost narrow down to a science when it makes sense to be able to start accelerating or deferring a lot of the income. And then with deductions too, it's depending on clients' goals for charitable gifts and things like that. What year does it make sense? Do we accelerate it into this year? Do we push it out next year? And then considering the impact of marginal tax rates. Clients are not always in the same marginal tax bracket. So if you have a big income year, then maybe that's the year to sort of accelerate a few deductions because now maybe you're hitting the top 37% tax rates. So really the idea is to leverage the tax benefits and with the fact, knowing what the consequences are of some of these moves, kind of figuring out when the perfect timing is. So let's start with our tip number one, which is pretty basic, and I'm gonna put it on tax planning basics, 101. Right? 101.
Everyone should be maximizing their 401k and IRA contributions. This is something that most people have access to. The only exceptions would be small business owners, but then we try to set up their own retirement vehicles. But if you are an employee, then you most likely have access to a 401k. And if you don't, you're always able to open up your own IRA. This is something that many people don't realize. Let's say you don't have a 401k. You can actually contribute to a traditional IRA as long as you have earned income. There's usually that myth where, oh, well, I make too much money, I'm not going to get a deduction. Well, here we are telling you, as long as you are under 70 and a half and you have earned income, you can start your own nest egg with a traditional IRA. Now, one of the big benefits, the reason we're saying, oh my God, this is 101, we have to do this, is because not only are you saving for retirement, but we're also getting a benefit by funding these accounts. So all of these dollars that go into the 401k and IRA are pre-tax. So that means that you're lowering your taxable income while saving for retirement at the same time.
Exactly. And, sometimes I've had some clients say, well, it's also a cash flow issue. And we'll go as far as saying, hey, we'll figure out where the cash flow needs will come from. Usually, they may have a brokerage account. So we'll consider going as far as, hey, try to maximize that 401k contribution, even if we need to replenish or replace that cash need from another account, just because the tax benefits are so significant. And then also just the tax-free growth over the course of 10, 20, 30, 40 years. I mean, it really is a powerful saving tool. And we believe that if you have access to this, you should absolutely try to take advantage of that. But I love what you said, because that I've had clients and other folks say to me, well, my income's too high, I just can't contribute to an IRA. And even if you have a 401k, we should talk about that.
Absolutely. Even if you have a 401k, you can also do a traditional IRA contribution. Now, you may not get a tax benefit up front, but that's okay, because that offers another opportunity to do Roth conversions. And we're going to get into that section in our tip number 2, but that's something to keep in mind. We may want to just put it in there even if we're not getting a deduction, because again, even though you're not getting the upfront deduction, we have these many years of tax-deferred growth. So there's 10, 20, 30 years that you're not paying taxes on growth, whereas if you put it in a regular brokerage account, you have to pay taxes on interest, dividends, capital gains every year.
Right, and the only caveat with making non-deductible contributions to your IRA, if we have some of our CPA friends on the line, is just making sure that you notify your CPA, because they do have to report that on a form to just track your basis. So you don't want to run afoul of making a non-deductible contribution and then forgetting that you actually didn't get that deduction, because that gives rise to basis. So that's something that you absolutely don't want to forget about. And all they have to do is put one more informational form just to track what that non-deductible contribution is. And then for those that are 50 years old and over, there's also an added perk here.
Correct. So you can actually contribute $6,000 to your 401k if you're over 50 on top of the regular $19,000. And these are 2019 numbers. Or in an IRA, you can contribute an extra $1,000 in the IRAs, both the Roth and the traditional. So
what can you do now? So we've just told you this is something you should absolutely take advantage of, and you're saying, oh my God, what do I do now? So what we're doing for our clients is we're looking for the year-to-date pay stub, and then we're just seeing how much they've contributed to date, and then based on the remaining pay periods left for the rest of the year. And this is why it's so important that we're doing this on November 19th, because it basically gives you about 6 weeks to kind of put your ducks in a row to be able to take advantage of some of these strategies. Look at what your year-to-date pay stub is, and then project out what you're expected to contribute based on the amount you have deducted from your pay for the remaining pay period. And if you see that you're not going to reach that 19 or the 25,000, then just make sure you bump up, if you could, the amount that you're contributing for the remaining pay period. Or maybe you have a bonus coming up. That's probably a good opportunity to just make up that shortfall so that you can reach the maximum by year end.
Absolutely. And then before we move on to the next slide, I did want to touch on Roth IRAs as another option, especially for those in the low income tax brackets. So even though with a Roth IRA you don't get a deduction up front, you're using after-tax dollars, it does give us the opportunity for tax-free growth. So similar to the tax-deferred growth of a 401k, except when you take out the funds in the future, you don't have to pay tax, unlike a 401k. So that's also another option for those in lower tax brackets. It's usually most ideal.
Right. And one more thing on the 401k that a lot of people don't realize is most of them offer a match. So if you're not contributing anything and your employer offers a match, then that's essentially just money you're leaving on the table. So if you can't do the maximum of 19 or 25,000, at least do the amount that the company matches.
So another way that we could consider accelerating income into a given year is by doing Roth conversion. So essentially you're saying, okay, how do I accelerate income? I'm an employee. Why would I want to do that? One of the ways you can do that is through a Roth conversion. So if you have a traditional IRA with all pre-tax dollars, or even with basis, it doesn't matter, we can convert it to a Roth. There's no income limits to that. So that's usually something that people forget too. We don't have to make under a certain number to do Roth conversion.
That was the case before. So before, there was always a game that people had to play, because in order for them to do a Roth conversion, their adjusted gross income had to be less than 100,000. That was eliminated. So now anyone can do a Roth conversion.
So that's something that we may want to consider in a low income year. So if you're traditionally in the high tax brackets, let's say that, unfortunately we were laid off, yes, that's bad news, but it also presents an opportunity to accelerate income and pay tax on that traditional IRA in a year where you're in your lowest tax bracket. So it makes sense to accelerate that income and then convert it to a Roth where now all of the earnings grow tax free.
Right, and usually this is a strategy that we like to pair with losses. So if we have some of our business owners, and for one reason or another they generated losses from the business, what we try to do is marry the loss to the Roth conversion. So in effect, we're converting tax deferred dollars and eliminating the silent partner that is Uncle Sam. By converting it to a Roth, it not costing us anything because we have a loss to match up to it, and then we take advantage of the tax-free growth. And the reason why this is so powerful is a twofold. Yeah, it's growing tax-free, but one of the big kickers is that with a traditional IRA, you have to start taking required minimum distributions when you reach 70 and a half. You're required or you'll be penalized. With a Roth, on the other hand, you never have to start taking out required minimum distributions. So this is super powerful for folks who expect to have large estates and expect to leave assets to their children or grandchildren, because they are essentially creating the tax-free shelter for their heirs. So this is the perfect asset to leave to your children because you've left them a tax-free annuity. So we love Roth conversions, and we could spend the whole 45 minutes on the Roth, but we're going to move on.
Absolutely. So my only caution is that it is taxable, so we have to plan appropriately. Any conversion that you make on pre-tax dollars will be taxable to you that year, so you want to be careful with how you plan for that.
And one note, before the change to the tax before the tax reform that took effect 2018, you were allowed to recharacterize a Roth conversion. So if for some reason maybe the loss wasn't as big as you expected from the business, or something else came through and all of a sudden you're in a situation where your income is a lot higher than you anticipated, you can no longer undo the Roth conversion. And that was one of the things we would always do, the strategy, because we'd say, just do it. And then before we file the return on October 15th, we'll see if we still want to keep it. And we would even play the game of, let's do the Roth conversion. And if the account drops in value, we'll undo it. But you can no longer do that. So you have to be 100% sure that this is what you want to do. And this, you do this by running projections so that you know exactly what the impact is going to be.
Absolutely. So then that brings us to tip number 3. So bunching of charitable giving and use of donor-advised funds. So now with higher standard deductions, with the tax law changes, a lot of people are finding that maybe they're not getting the benefit from their charitable donations that they were before because the standard deduction is so high. So now we've had to come up with some more creative solutions to actually getting a benefit for our charitable gifts. And one of those is through the use of a donor-advised fund. One of the huge benefits of this is that it's your personal, we'll call it your personal foundation. You can put funds in this account, get the benefit today, and then over the next few years, you can start doling out your donations. So let's say every year you give $5,000. We know that this is what we plan on doing. So we can just front load $30,000 worth of gifts, get the actual benefit today, and then spend the next few years making our usual donations from that account.
And you know how much I love donor advised funds,
know.
because not only is it a great tax planning tool, but I think it really presents an opportunity for family conversations around your legacy, and I think it's such a powerful conversation you can have with your children that you've established a family foundation, and you should all kind of think about what's near and dear and what causes the family wants to support, and this is a great vehicle for that.
Absolutely. And then our next slide is going to talk about the best way to fund these donor-advised funds.
So putting the donor-advised fund on steroids.
Exactly. So anyone can do cash. You can always put cash in these donor-advised funds. But Nella, tell us what's our favorite way of funding these accounts.
Yes. Okay. So I'm gonna just start by saying that sometimes when I'm looking at client tax returns and I see two things on a tax return, my heart drops. I just feel the pain. And here it is. I see a tax return and I see that clients have substantial capital gains. Okay, they sold some Facebook, they sold some Amazon. I mean, they just sold all these securities and they triggered some significant capital gains. And then I keep turning the page and then I see that on Schedule A, which is where you show your itemized deductions, I see substantial cash gifts. And I said, oh God, no one has talked to him about how to make the most tax efficient gifts. So the way we like to approach your charitable giving, especially if we're going to use a donor advised fund and we're going to pretty much lump a few years of donations into your donor advised fund, is we scan through your portfolio and we're going to look for whatever position you have that has the most appreciation. And then that's what we want to pick. We want to pick whatever stock, whatever fund you have in your account that has grown substantially, that you've held for at least 12 months, because it has to be long term. And then we take that position, and let's say that it's $50,000 worth of Facebook stock. We take the Facebook stock, we contribute it to your donor advised fund. You're going to be able to take a deduction equal to the fair market value of the Facebook shares that you just donated. So you're going to get a deduction of, let's say, $18,500, assuming that you're in that particular tax bracket. So you're going to get an income tax deduction of $18,500. But here's the kicker, is nobody has to pay the capital gains on all of the Facebook appreciation. So not only did you get a deduction of $18,500 for donating the shares to your donor advised fund, on top of that, you avoided the $7,140 that you would have otherwise paid on the sale of the Facebook stock, calculating that at 23.8. So the way I like to look at it and the way we usually communicate with clients is essentially this donation only cost you about $24,000. How? Because you got an $18,500 deduction and then you avoided the $7,000 of capital gains. So out of a $50,000 donation, it cost you 48 cents on the dollar. I mean, that's just so powerful. And if you're very charitable, you have annual galas and commitments, this is, an ideal way. And this doesn't mean that if you already know what organizations you would like to benefit, whatever organization is near and dear to you, if we can transfer the stock directly to them, if you're ready to make that commitment this year, then it goes straight to the organization. We use the donor advised fund as a parking spot in case you don't know where you want the funds to go, and then you don't have pressure of doing it by a certain deadline.
And also, some charities don't have brokerage accounts, especially for those that are smaller. So this also offers a nice way you can transfer the security into the donor advised fund and then from there write a check. So it really does offer you the flexibility of donating in a tax-efficient way to a charity of any size, whether or not they have the brokerage account to receive securities.
Perfect comment there. And I think this too, for folks, we have a few clients and what they come here, they're, an executive at a Fortune 500 company and they have concentrated positions. So we talk to them about using a donor advised fund to diversify out of that particular concentrated position and then fulfill another need. That's why, it's so important for us to get to know the client and really understand all of their goals because we're able to plan around them. So someone has an issue with concentrated position, highly appreciated securities, and then they're also very charitable. Boom, that's like a perfect recipe for something like this.
Absolutely. So then moving on to our next tax tip, loss and gain harvesting. So I'm sure everyone's heard of loss harvesting, but I'm sure you probably haven't heard of gain harvesting. Why would we ever want to trigger gains in a portfolio? So I'll first start with loss harvesting. So what that means is that you're turning paper losses into actual losses in order to offset gains throughout the year so that you're not paying as much in capital gains when you file your tax return. Now, this has to be done by the end of the year. This is something that can't wait until April 15th. So this is something that we look to do not only at the end of the year, but also throughout the year. And I'm going to use this year as an example. The market, yes, has been volatile, but right now the market's been great. So we're really having trouble finding losses. But we've used that volatility throughout the year to really lock in losses and bank them so that we can use it to offset gains now that we're at the end of the year and don't have that opportunity.
Right. I mean, 2018 was, it was the opposite. I was saying as I'm watching CNBC and watching the Dow take a 1,000-point drop, I'm thinking, the tax gods are listening to me. Because that was an easy year. I mean, we came in, we just had ample opportunity to really harvest losses and bank them and use them to offset all of our gains that we had from 2016 and 17. But, the point is that you have to be proactive here and really look through all your accounts to find opportunities to bank those losses and trigger them. Because at the end of the day, not doing so, it's a lost opportunity. We know the market is going to rebound, but you're sitting there with paper losses. It's like turning lemons into lemonade. And we do caution people, if you don't know how to do this strategy, I wouldn't recommend just, getting out of an entire sector in the market to trigger a loss, because if that particular sector goes right up, now you've let the tax tail wag the dog and economically you were worse off. So the way we do it is we're cautious of the wash sale rules. So you can't just I'm going to just use Tesla, sell Tesla just because the lots you bought are at a loss, but you really love that company and you feel that they're really going to go places. So you buy the shares right back. You can't do that because the IRS knows what you're trying to do, and basically they disallow those losses. So what we have to strategically do behind the scenes is that we have to make sure that we're smart about, yes, taking the losses. It could be in emerging markets, international, and then making sure that you're also not completely out of that exposure, because if it takes off, we've undone the tax benefit in the economic loss in the account. So that's one thing to just make note of. But harvesting gains, let's talk about that a little bit.
So I want to go back to that 0% tax bracket that Nella was talking about earlier, and those are for folks under a certain income limit where if they have any capital gains realized, they are indeed in a 0% tax bracket, so they don't pay taxes on any capital gains. So in a perfect world, we would harvest gains to the extent that they're still in that bracket and not $1 more. So this does require a lot of planning. We wouldn't recommend just blindly harvesting gains because we think we're in a 0% bracket, because you could inadvertently put yourself now in the 15% capital gains bracket. So it does take a lot of planning and being careful, but that's an opportunity that we look to take advantage of every year, because otherwise it's just income you could have taken, stayed in the 0% tax bracket, and it's lost if you don't do it in that year.
Right, and it's like giving yourself a free step up in basis, because there's no rule against selling at a gain and then buying it right back. So there's no such thing as a wash sale rule on capital gains. So that one, you can do that every day, every night. The IRS is not going to be upset with you if you're triggering gains.
Exactly. So now our tip number 6, health savings account. So these are our favorite. So we call these the Triple Crown of tax savings. So these are health savings accounts associated with health insurance policies that have a high deductible. So you're only eligible for them if you have a high deductible HSA eligible plan. So before you go and open an HSA, just because I said it's the Triple Crown of tax savings, be sure you're eligible. But the reason we love these so much is because it's the only type of investment, I dare say it's even better than the Roth, which I know is a big thing, but it's even better than the Roth in that the dollars you put in are pre-tax, it's going to grow tax deferred, and then when you take it out in the future, as long as you use it for qualified medical expenses, it's also tax-free. So at no point are you paying tax on these dollars. So that's why we call it the Triple Crown of tax savings. So it really does offer a good opportunity if used correctly.
I was going to say, if used correctly, maybe talk about what does that mean? Because if you just set it up and you're putting dollars in there and it sits in cash, let's talk about that.
Yeah, if it's sitting in cash, then we're not getting that tax-free growth. It's just sitting there. So you're only getting 2 of the benefits. It's going in tax-free, and then you're using it tax-free. Now, what we really want is that tax-deferred growth in between to truly maximize the savings on this account. So how do we do that? I set up an HSA to pay for health expenses, right? That's what most of our clients tell us, but we tell them no. If we can, the best way to do this is to really pump up the HSA and pay for your medical expenses out of pocket and leave the HSA alone. Just let it sit there and grow, invest it, don't let it sit in cash, so you can really stretch out the growth on this account and truly benefit from the tax-free nature of it.
Exactly. And I was going to say there's an app for you to track those medical receipts, because we would tell our clients not to reimburse themselves. And another way that we've told people to use it is we've had young couples, and they say, well, we have an HSA, but we haven't funded it yet. But I just learned that I'm pregnant. And she's like, but I don't know how much my medical expenses are going to be. And for sure, they're not going to be able to deduct medical expenses on Schedule A. So we immediately have them just open it, even if they just add $1. And then let's say they deliver the baby, they find out they have an out-of-pocket cost of $6,000. Well, guess what? Since you had the HSA established before you incurred the medical expenses, you can then go ahead and deposit the amount that you're going to pay for that hospital bill and go ahead and just reimburse if you're using it to truly reimburse yourself. But at least you got an above-the-line deduction for your medical expenses. So it's important to just set it up and have it established.
Absolutely. And just a really big point to note is that you don't have to have medical expenses in the year that you're taking distributions from the HSA. So that's why Nella said keep your receipts. You can keep your receipts from today, and then in 5 years when you want to go on a trip, let's say, hopefully longer than that, we really want this to grow, but let's say in 5 years, You didn't have any medical expenses in that year, but you've kept all your receipts. And if those receipts total, let's say the $5,000 you want to take out, you can take it out that year.
Tax-free.
Tax-free. So even though you're using it for a trip, you have the medical expenses to back it up to justify taking it out of the account.
Perfect. Withholding. So if we speak frequently, you'll hear me say that I just do not like floating an interest-free loan to Uncle Sam. So what we try to do here is this idea of really controlling how much we're paying in estimated tax payments and really trying to delay that to the 11th hour. And maybe some of you are saying, but no, my CPA tells me I have to make estimated tax payments or I'm going to have penalties. And so we would never want anyone to be in a penalty situation. So we use IRAs as a perfect example. So maybe let's talk about the way we use IRA required minimum distributions to really control our estimated tax payment requirements and avoiding penalties.
Absolutely. So this strategy is really only going to be for somebody who's over 70 and a half who has required minimum distributions. You can't just withhold from an IRA willy-nilly. So this is going to be more for those folks in RMD mode. But what we do is we use the RMD in conjunction with our tax plan to determine, okay, we haven't made any estimated tax payments all year. We need to pay something. So then we actually look at what the estimated tax liability is going to be and withhold as much as we would have done in quarterly estimated tax payments, but we do it at the 11th hour as late as we can in December. And the kicker is that withholding is going to qualify as counting for the entire year.
So that the beauty of withholding is that even if you do it on December 31st, it gets treated as if it was paid pro rata throughout the year. So that it goes back to the point I was making. This year's a perfect example too. If portfolios are up, 15, 16, 17%, you kept what you would have otherwise paid the IRS in estimated tax payments. You kept that growing for you. And now we go in December and run a projection and figure out that you owe, say, $70,000. Guess what? Your RMD is exactly $70,000. We'll send it all to the IRS. You never paid a dollar throughout the year, and you took care of two birds with one stone. You took your required minimum distribution, and you covered your entire tax liability. But if you're not over 70 and a half and you don't have an IRA required minimum distribution, there are other things that we could be looking at. And I think you had a perfect example just yesterday.
Absolutely. So one of the big things you could look at is how much you're actually withholding on your pay stub. So on the Form W-4, when you start working with an employer, they're going to ask you, how much do you want to withhold? They're not going to ask you that. They're going to say, how are you filing? Married, single, had a household? And then how many exemptions do you have? So that's going to determine how much you withhold. And something that we've noticed is that this needs to be looked at every single year. Even though we do it when we start our job, a lot of people...
Maybe even throughout the year.
I
had a situation where my client's exemptions were changed from 3 to 9, and he has no idea how. Something happened in their system that they just adjusted the withholding.
Exactly. So it's something we need to look at. I actually had a client who at the end of last year got divorced. So what happens is if you're divorced on December 31st, you're considered divorced for the entire year. So now even though she was withholding as though she were married, she actually had to file her taxes as single or had a household, which is a completely different tax bracket. So we ended up in a shortfall. So that's something that you want to review, again, at least once a year, maybe even more, just to make sure that we're withholding the appropriate amount given our situation that year.
Excellent. And if you have a bonus at the end of the year, you can maybe use that to make up some of the shortfall just to avoid the penalty. And the general rule, just before we wrap up on this section here, is you're only required to pay to the IRS and estimated tax payments the lesser of 110% of your prior year tax liability or 90% of the actual. So if you have an extraordinary year this year, you sold a business, you had significant capital gains, or a new package through work and significant wages, this is the year that you're going to pay in based on your prior year. Again, just so that you pay in as little as possible. Of course, we're going to be smart about putting in a reserves account the cash that you need to pay the balance due in April. But I'm not a big fan of paying all of that in advance. I'd rather just reserve for that, have the money earning interest or growing for you for 6 months or whatever that period is, and then pay it later on. Qualified charitable distributions. This is such a powerful tool, and up until recently, this was one of the areas in the tax code that was always an extender, meaning that it was never part of the actual tax code. It was always one of those things that Congress would consider extending or not extending. So it was always so hard to plan for this because we never knew if they were going to bring it back or not. But here's how this works. So if you're over 70 and a half and you have to take a required minimum distribution, you are allowed to fulfill that required minimum distribution via a direct transfer from your IRA to a charitable organization. It has to be a 501c3. So, and it can't go to you first. You can't take $1,000 in your name and then transfer it to a charity. It has to go straight from the IRA to the charitable organization, and that qualifies as part of the required minimum distribution. And here's the beauty of it. It is essentially an above-the-line deduction. If you've heard people say above the line, below the line, what does that mean? What line? So basically, you're reducing your income right at the top. So your gross distribution, let's say it's $75,000, but you took $15,000 and donated it directly to a charity. The taxable portion of your IRA distribution is only $60,000. So that is so powerful because it's not even affecting your taxable income. It doesn't even go into your itemized deduction bucket to see if you're, if that's greater than the standard or not and how much are you eligible. It's just an above the line deduction. And this is so critical, especially for folks who worry about Medicare premiums, because a couple of things, Medicare premiums and also the net investment income tax, which I don't think we've talked about. So even though IRA distributions are not supposed to be subject to this infamous net investment income tax, which is another 3.8%, the calculation for the net investment income tax is driven by your adjusted gross income. So if you have a large IRA distribution, guess what? It's bumping up your adjusted gross income, causing you to be subject to the net investment income tax. So this is also a play. And this is what I mean by not looking at one strategy in a vacuum, because it affects so many other things. And then Medicare, we have clients who say, Nella, as soon as my income goes over that darn $170,000 threshold, all of a sudden I'm paying $500 a month for my Medicare premium. This is another way for us to try to control what your adjusted gross income will be by reducing that number via qualified charitable distributions. But there are probably a couple of things that clients need to know when they do this.
Absolutely. So one thing is, again, it has to go directly to a 501c3. We have to be careful. It can't go to our friend's charity. It has to go to a qualified charity, 501c3. Also, you do need to keep that acknowledgement letter, same as if you were itemizing your charitable deductions. And the big one is that these are not reported on your 1099. So in Nella's example, you would typically get a $75,000 1099 saying that's how much you took out of the IRA, but the custodians aren't responsible for saying whether it went to charity or whether it went to you. So it is the taxpayer's responsibility to tell the CPA, hey, I did make $15,000 worth of charitable contributions from my IRA, so they need to be able to manually deduct that on your tax return. So that's one really big thing to look out for, because you could be in a situation where if you don't tell your CPA, you could potentially be paying tax on something that you gave away and you shouldn't be.
Yeah, that's a big one, and usually we've caught that when we get the final copy of the return. And we see that right away. It's supposed to say QCD on the top, and it shows that you're reducing your taxable IRA. Right away, we gasped for air. We said, oh, it was missed. So then we have to go back and, depending on the dollar amount, consider amending.
So if you're charitable and you're in a situation where this is an option, we do recommend a qualified charitable distribution, even above doing the gift of appreciated securities,
Oh,
because
yes.
this does not matter whether you're itemizing or not. This is that above the line deduction. So if this is an option, we say donate first from your IRA, and then if you want to do more, then we'll look into other options. But this is our first stop.
And you can do up to 100,000
Mhm.
per taxpayer. So if you and your wife have RMDs, you can each do up to 100,000. All right. For our self-employed folks and business owners, this is we love the opportunity to really get creative with folks who have consulting income. They may be on the board of various companies and they get paid for their service. They may have sold a business and have a consulting contract with the buyer of the business. So many things. So this usually presents a powerful planning opportunity. These would be opportunities to establish your own retirement savings plan. This could look like a solo 401k. So if you don't have any employees, we can go that route. And then similar to the limits we were talking about before, you can defer up to 19 or 20, 25,000 into your own 401k, plus add a profit sharing piece. We also I like to use the word put it on steroids, but we could incorporate, depending on your age and the dollar amount, we can incorporate a defined benefit plan and really boost our deduction. So I love my example of, we had a dentist who had a practice, and just in the practice alone, he made about $500,000 a year. And I remember going back to the CPA and saying, hey, I see that we have a 401k in place, but have we ever considered a defined benefit plan? And the CPA, because she didn't know the whole picture, and it's not her fault, it's just kind of most CPAs, unfortunately, you only know what the client tells you. And so she's like, oh, well, he doesn't have the cash flow from the business to really make a substantial contribution to a defined benefit plan. But I knew we were managing an account with over $1 million here. So we had the cash available to do any tax planning strategy. So, of course, we incorporated the defined benefit plan, and it was yielding tax savings of about $75,000 a year for the dentist. And it was just, again, looking at all the pieces of the puzzle. So if you have consulting income, this is a great opportunity to take advantage of some self-employed retirement type accounts. And I think you wanted to mention on SEP IRA and Simple, I think we default to the solo 401k.
We do. The only time we generally recommend a SEP IRA is if we miss the December 31st deadline to set one in place.
To set up a solo, right?
To set up a solo 401k, because typically we have until the extended due date of the tax return to actually make the contribution. But the only caveat with the solo 401k is that it needs to be in place by the end of the year for the year that you want to make a contribution for. So if we wanted to do it this year for 2019, we have to open it before 12/31. Now let's say we miss this. We have a new client who came to us, and we missed that deadline, so perhaps we'll open up a SEP IRA in its place, and then for the following year, convert to look at a solo 401k option. But the reason why we're hesitant with the IRA options is that it's included along with other traditional IRAs when you're making those Roth conversions that we were talking about. We said that they're complicated. You want to be careful with them. So if you have tax-free dollars in a SEP IRA or Simple IRA, you do want to be careful when doing Roth conversions because it is included. Your 401ks are not. So we do want to be careful with the type of accounts you have before you do Roth conversions.
Exactly. Okay, so this is a topic that comes up very frequently whenever we're looking at forward-looking projections of whether our clients are expected to have a taxable estate or not. Then we start talking about ways to try to reduce the projected taxable estate in the future. And annual exclusion presents an amazing opportunity to do this. The more kids, the more grandkids you have, obviously, the more powerful the annual exclusion planning is. But let's talk about this. So as you may all know, everyone has an $11.4 million estate tax exemption. So couples, you're looking at 22.8. So to the extent that you're expecting your taxable estate to exceed that number, then you really need to start thinking about ways to reduce that taxable estate. And it doesn't necessarily have to be that high. We know that as of right now, this is supposed to sunset in 2026. So 2026 comes around the corner, we're going to revert back to the $5 million exemptions we had back in 2017. But let's talk about annual exclusions. Whenever we have that situation, we like to talk about making sure that you're maximizing your gift. This is a use it or lose it. There's no tax deduction. But if you don't give your annual exclusion for this year, it's not like you can roll it over and then do it next year. So it's $15,000 per person. Couples can do $30,000 per person, and they can elect to split gifts. It can come from one account. But let's talk about where these gifts should go.
So one of our favorite uses of it is a 529 plan, and it is a completed gift. However, you still maintain control of it. So it really is a nice way to get those funds out of your estate, but still maintain some control if they don't go to college or if we need to change it to another beneficiary. So that's a really nice way of shifting some of the assets to the next generation.
But still maintain control.
But still maintain control. And what's really nice is that Nella was just talking about those $15,000 limits. We can actually super fund the 529 by doing a front-loaded gift of 5 years worth of annual exclusion. So a married couple can put $150,000 per child in a 529 plan. So it really does offer the opportunity to take funds out of our taxable estate right away.
Excellent. And then the only thing I'll mention here is just be careful if you have a life insurance trust that you're making gifts to. Those transfers to life insurance trust do count as part of your annual exclusion gifts. And also, if you're funding Roth IRAs for your kids, that's also an indirect gift that you've made to your kid. And then the last part here is that education and health related expenses paid directly to an institution do not count as a gift. So we'll leave you with those 2 points there just in the interest of time.
All right, so our number 11, beware of stock options impact on tax. So Nella, can you tell us a little bit about those?
Yes, so this is for our executives out there. If you're exercising incentive stock options, you might already be aware that there's an AMT implication associated with exercising ISOs. So in the interest of time, what we'll say here is if you do have incentive stock options, you do need to look at projections and kind of see where you are in the tax bracket and whether it makes sense to consider doing disqualifying dispositions of those incentive stock options to accelerate the ordinary income pickup. And then just from a practical standpoint for our CPAs out there, just making sure that we don't lose track of the AMT basis on the exercise of the incentive stock option. I've seen that oftentimes when they go ahead and actually then sell the stock, that somewhere along the way the AMT basis was lost, and then we didn't get the credit for the corresponding tax that was paid in years prior. So this requires an in-depth analysis, and if you have a situation like that, then you probably want to come in and just have us run some modeling.
Absolutely. This is not a DIY
no.
tip.
No, that one be careful with.
So number 12, passive activity loss rules. So this is something that we always like to point out because passive activities or passive losses generally can only be offset against passive income. So what does that mean? So that means anything like an investment, like a rental property. These are things that are considered passive. You're not actively participating in it. So I look at a rental property as an example. I have clients tell me that they got a rental property so that it can have these losses year after year, but what they don't realize is that you need to have passive income to offset it. So what happens year after year, it just gets suspended. It just sits there. And so we do one of two things. We have passive income to offset it against, or we actually sell the property or the investment, whatever is causing all these losses, and then that's when they get released in the year that it's sold.
Right. So sometimes we'll observe that there are huge passive loss carryovers, and then the client's not even aware of it because it may have been an investment they made in ABC Company LLC years back, which is like a partnership, but they're not involved. A friend told them to invest, and then realized they had $100,000 of passive loss carryover, and we'll tell them do you just want to sell your interest in this LLC, and then once you sell it, all those passive losses are released. So towards year end, we're looking for clients who have all these passive losses sitting on the books, and we try to trigger them.
And then just to caution on the DIYers as well, we've also seen that, I'm going to go back to the rental property, where they didn't realize they had all of these suspended losses year after year, and they actually did a 1035 exchange on a property that if it had been sold that year, you wouldn't have paid any taxes on it because it was still at a loss. So we want to make sure that you're aware of those passive losses that are being carried forward.
That's a great point because we actually just saw that. So.
We did.
And then the last point we have here is, and this is something we're very passionate about, and it's making sure that you look at your portfolio. And again, tying in tax planning with investment planning. And people say, well, what does one thing have to do with the other? It has everything to do with each other, because how much you make is important, but it's more important how much you get to keep. So thinking about the composition of your portfolio and looking at what assets you're holding and what accounts could make such a significant difference. If you're not focusing on what specific holdings are kicking off ordinary income and you hold those in your taxable account, you're paying 37% tax on that. So it may have yielded 8%, but guess what? You're paying 37%. It's actually about half of that. So it's very important that you're looking at holistically the composition of your portfolio and then just seeing what investments you're holding in what accounts so that you can make smart choices about your fixed income allocation. Should it be in taxable bonds versus municipal bonds? If municipal bonds are not yielding as much as taxable bonds, then maybe we just move the whole position to tax-deferred accounts so that you don't have to pay the tax on that income currently. So if you have any questions on that, that can get a little complicated. But it's really kind of looking at the composition of your portfolio, but not just account by account, but just everything together as one big pie, because that's how we look at it. So, okay, any questions? We see we have some questions already. One question is there an income limit for contributing to a Roth 401k? Yesenia.
So I got really excited when I saw this question just now. So there is no income limit to a Roth 401k, unlike a Roth IRA. So in order to go directly into a Roth IRA, yes, there are income limits. You have to make less than a certain amount depending on your tax filing status. But with a Roth 401k, if your company does offer it, you're subject to the same $19,000 contribution limit, but it doesn't matter how much you make. So it's really a way of getting around those income limits for Roth IRAs. And you could theoretically put $19,000, or if you're over 50, $25,000 into the Roth 401k. So there is no income limit. Thank you so much for asking that. That's a really important point to bring up.
Excellent. And then I think there was one more question on the difference between an FSA and an HSA. Can I have both?
Yes. So they are two different things. The HSA depends on the type of account, the health insurance that you have, the high deductible. The FSA doesn't depend on whether or not you have a high deductible plan, but they have different limits. And the FSA, if that's all you have available to you, then it is a great tool. You can put dollars in there pre-tax, subject to certain limits for health or dependent care. But it is a use it or lose it type of situation. So if you put in, let's say, $5,000 for dependent care and you don't use it, you can't roll the entire amount to the following year. You can only roll over a small section.
Yeah.
So we want to be careful. The HSA, you can leave it there, and that's why we recommend pumping it and letting it grow over years. But with the FSA, you don't have that option.
You almost have to budget before you make your election, and a lot of folks are making their employee benefit elections at this time, or may have just looked at it, is sort of budgeting what you expect to incur in medical expenses. If you have 3 kids like me, I'm kind of looking, all right, I'm going to have to take them to the dentist a few times, a couple of doctor's appointments, and you just kind of budget on what you expect your out-of-pocket cost to be, and then limit the FSA funding to that dollar amount because, and then they also restricted it. Before, you used to be able to just buy over-the-counter medicine and that all qualified. They've gotten a little stricter with it, so just be careful with that because that truly is a use it or lose it. They give you until like March 15th of the following year to incur expenses to use the prior year balance. So I think that's it. I don't see any more questions. Thank you all for spending this Tax Power Hour with us. And if you have any questions on any of the strategies we talked about, any specific questions with your case, feel free to give us a call. We'd be happy to talk you through it and see what things we can help you implement. You have 6 weeks left to get creative. So have a great Thanksgiving and enjoy the holidays. And we look forward to speaking to most of you as we work through your year-end tax plan, because that's what we're doing now. Talk to you soon.
Take care. Bye-bye.
Bye.